Recently, the data came out for the September home sales report. And what does the data show? Well, from year over year, sales are down 31%. Yuck. And then when you compare from August to September, sales are down 10%, which is worse than the 4% decrease that economists predicted. And add on top of that, there are less listings on the market than there were before. Now, why is all of this happening? Well, from the sellers that are not putting their house on the market, it's because a lot of them have the low interest rates and they don't want to give up their low interest rates. Now, when it comes to buyers and less purchases, the higher interest rates is causing many more buyers to decide to wait to see if the interest rates were to come down. Now, is this all doom and gloom? Absolutely not. This is a fantastic opportunity for realtors that are willing to put the work in, because people are always going to be buying and selling houses no matter what the interest rates are. So in this type of environment, the person that puts in the most effort is going to come out further and ahead. And what's going to happen are the realtors that are not putting in the effort, they're going to have to get out of the industry. So while the pie might be smaller of a business that's out there, there are going to be less people going after that pie. So despite what you see, this doom and gloom news, this is a fantastic opportunity to take advantage and really build yourself a fantastic, long-lasting career. With the increase in interest rates, many more borrowers are looking at ARMs, or adjustable rate mortgages. Now, this video is not to say whether that's a good idea or not a good idea. This video is to explain the different numbers that are associated with the various different ARMs that are out there, because not all ARMs are the same. So let's talk about that. The first thing you want to know is, what is their payment based off of? How many years is their payment based off of? Well, when you have the interest rate, it's typically amortized over a 30-year period. So whatever their interest rate is based off a 30-year period. Now, it's the first and the most basic part. But then you have the different numbers. You might have a 5-year or 7-year or a 10-year or a 6-month. That is indicating how long their initial interest rate is guaranteed to be fixed at. So whatever their interest rate is, say it's a 5-year ARM, that interest rate they start off with is guaranteed to be the same for the first 5 years. If it's a 6-month ARM, that interest rate they start with is guaranteed to be the same for at least the first 6 months. If it's a 7-year, so on and so forth. Again, that's pretty simple too. But here's the confusing part. Are these different schedule or these different adjustment schedules? You might see the two most common ones I see are 215 or a 515. Now, what do these different numbers mean? Well, that first number, let's just use a 215. Let's say you have a 5-year ARM. So that interest rate is fixed for the first 5 years, but then has a 215 adjustment schedule. That first number, in this case, a 2, means what's the max increase that interest rate could see on the very first adjustment. So after 5 years, let's say the rates and stuff go up, the max first time adjustment could be 2%. That's only on the very first adjustment. So on the 215, that 2 indicates the max adjustment could be up 2%. Now, what is the 1? The 1 is indicating what's the max adjustment on every adjustment thereon after. So every year after that first adjustment, the max adjustment, either higher or lower, could be 1%. So that's the 2 and the 1, and then what's the 5? The 5 indicates what's the max lifetime adjustment that could be, so the cap, and that would be 5%. So that would indicate that whatever your base interest rate is, the highest it ever could go over the life of the loan is that interest rate plus 5%. Let's say you had a 6% interest rate, the max lifetime cap is 5%, so you could take that 5 plus a 6, the max highest interest rate is 11%. So there you go. A lot of loan officers don't even know what these different schedules mean, because most loan officers have never been in an environment where the ARMs have been a thing where it's been needed, because the last several years interest rates have been so low. Now, I'm not saying ARMs are right for every borrower, but they are right for some borrowers. So if a client of yours is looking at ARMs, don't be afraid of them. Make sure you talk with a great loan officer that does understand the different terms and the different payment schedules, because it means a big difference to your client.
All right, last week, rates. The Fed raised the interest rates about 75 basis points. And it looks like they're going to raise them again here in December, 13th and 14th. They're doing this to try to lower inflation, stave off inflation, but we'll see what happens. And we will also see what happens with the housing industry. How will it respond? Will we go into a downward spiral? I don't think so, but let's see what happens.
share with you a huge opportunity we're seeing many realtors take advantage of right now that is helping them get more clients in this market. Specifically, people they were working with before, but a different loan officer told them, sorry, you're not ready yet. Now, before I share with you this huge opportunity, let me share what this opportunity is not. This is not for clients that have terrible credit. This is not for clients that have no access to any funds for down payment. This is not for clients that have no way of proving their income. What this particular program is for people that we just missed traditional qualifying. We're calling this our just missed program. What this does, it helps buyers that don't fit exactly the traditional mortgage guidelines, but they're almost there. Think about it for the person that might be self-employed. Typically with self-employed, you need 2 years of history of self-employed income to use that income for traditional financing. Many people right now, they don't have that. Well, this program can work for them even if they have 1 year of self-employed income. Now let's talk about people that have commission income or bonus income or overtime income or some other variable income that can change from month to month or year to year. Typically on that as well, you need a 2-year history of receiving that. With this particular program, you don't need a 2-year of history of receiving that in order to use that particular income. Now let's talk about borrowers that want to qualify for I-10. I-10 traditionally is going to require 20% or more in order to purchase a house. With this particular program, you don't need 20% for an I-10 borrower. You only need 3.5% down for an I-10 borrower. How about your clients that may have been turned down because they have too many student loans? Now, those student loans are in deferment status, but with guidelines the way they work, you still have to factor a payment, which crushes many borrowers. With this particular program, if they have student loans in deferment, we don't have to factor any payment for them. So it's a great product. It's not for everybody, but for those that are close but just not there, it might be a great fit for them. So go back to your database. Think about those clients that you were told, hey, you got to wait 6 months or a year. Hey, you got to wait till you have 2 years of this or whatever it might be. Those people might now be eligible to purchase a house. We're seeing many realtors that are now getting accepted offers with these particular kinds of clients. Do this to this exceptional opportunity for this loan program. Thank you for watching this week's H.E.R.O Alert. Now, if you found some value in this, do me a favor, click the subscribe button so you'll know the next time we release a video. Also, if you liked it, give us a like. Now, I also have one more thing for you. If you have any questions, comments, good, bad, or ugly, please comment them below because we reply to every single comment. Thanks again for watching and make it a superhero day.